Hello and welcome to Starting Up. We come to you this week from Dalal Street. And you might wonder why, because this street has for long been the favored ground of large listed companies. All that is set to change though, because the BSE is all set to launch its younger brother. Yup, the BSE SME Exchange. For the first time, the folks at the Bombay Stock Exchange have given me and 8 entrepreneurs inside access to what the new BSE SME Exchange will actually be like. Fasten your seatbelts for this Starting Up special. So I'm at the BSE and I'm here for this very special session on the BSE SME Exchange. I'd like to introduce my guests. I have with me Mr. Ashish Chauhan, the Deputy CEO of the BSE, and Mr. Lakshman, the CEO of the BSE SME Exchange. We also have 10 of India's fastest growing companies from across multiple sectors, and they're going to be quizzing Lakshman and Ashish on the SME Exchange and hopefully looking at suggestions for the exchange as well. So Ashish, I'm just going to start this off by asking you when and how the thinking behind the SME Exchange started. So what are some of the pain points you noticed in the market which said that, hey, there is a need for this exchange right now?
The concept of an SME framework has been there for long in India. There are basically largely 3 aspects of the enterprises coming to the market. One is the enterprises themselves, that small and medium enterprises. Today, if they have to come to the market, the collection cost, the IPO cost is very, very high. On the other side, the investors have been very wary of small and medium-sized companies. With these 2 sort of situations, the SME sector was not trying to come into the market. Within the companies themselves, if there are promoters, they need liquidity.
Perfect.
And so that is a good background for...
So lack of liquidity for both founders and investors in some way.
And that is on the company side. And on the investor side, there is an issue of the name recognition,
right,
the transparency and the expected performance of the companies and so on and so forth.
So Lakshman, I'm going to take the next question to you. It's a question a lot of the entrepreneurs here have today. What are the eligibility criteria for the BSE SME Exchange?
Eligibility criteria as such is very simple. There has to be minimum 50 shareholders.
Right.
And I mean, paid up capital, there is no restriction, but post-issue paid up capital has to be within 25 crores.
Right.
Up to 10 crores, it has to be they have to be mandatorily an SME exchange. Right. And if the post-issue paid up capital is between 10 to 25 crores, they have an option. If they want to move to main board, they can move it, or they can stay on SME exchange.
Right, right. What about in terms of profits or revenues?
They have to be profitable for 3 out of 5 years and should have a dividend track record and all that.
To recap, the eligibility requirements to list on the exchange are the following. There must be a minimum of 50 shareholders investing 1 lakh rupees each. The post-issue paid-up capital cannot exceed 25 crores. If the post-issue paid-up capital is between 10 and 25 crores, the company can choose between either the main or the SME exchange. If, however, it's less than 10 crores, the company must stay on the SME exchange. In terms of profitability norms, every company that lists on the exchange must have a track record of distributable profits for 3 out of its last 5 years. A norm that certainly isn't music to the ears of the internet sector.
I'm going to throw it up open to the audience. Ravi, the CFO of Paymate. So Ravi, your question?
You just mentioned about the paid up capital range. So there may be an advanced company or a company in the late stage where the paid up capital may be probably within the range, that's less than 25 crores. But the size of the issue may be much higher. Like, let's say, if the company has been in business for 4 or 5 years, or it's already an established player, so obviously it would like to cash in on the efforts that have already been put in. So the size of the issue may be 200 crores, but the paid up capital may be 20 crores.
You are right, actually. I mean, it all depends on the market value of the share. A 10 rupee share may be 100 rupee in the market. If that is the case, it will be 25 into 10 times. It could be 250 crores.
Yeah.
So, I mean, you are right. It can go, I mean, depending upon the market conditions, company's track record, image of the promoters and all that, and the appreciation it gets in the market. It can be much higher.
So Lakshman, you're saying there's no restriction on the amount of money a company can raise on the SME exchange as opposed to the BSE exchange?
Yes, theoretically, I mean, there is no limit. Right. But practically, I mean, you can say generally the issues will range between about 25 crores to it can go up to 100, 150 crores.
Okay, Vijay, you had a question?
Any reason for having profitability norms? Take example, the software companies, which has very significant growth, but they are in the investment mode and they're looking for more money to be put in back in the company. So you don't see that the profitability norms, all over the world really. Why is it out here?
Ashish?
See, basically it's also something to do with the Indian capital market history. If the company is already profitable, the chance of its or the probability of it remaining profitable is pretty high. And when you are taking the money from the small investors or even investors at large who are not connected to you, they need to have that comfort that the company is already profitable and they are basically they are coming to the market for their growth. And that's where there is a bit of a balance to be maintained, and that's where we think this is the correct balance.
So, Ashish, is this a norm that could change, or is it written in stone?
See, basically all the regulations in a sense evolve. If some of the companies end up giving good returns to the investors and there is more comfort, that time one can think of looking at this kind of what I call slightly more stringent regulations in a different way.
Perfect.
But today the prime importance is of getting the investor confidence into the SME segment. Without that, without gaining that confidence, we kind of run the risk of
shooting yourself in the foot. I just want to introduce Manu of Naptol. Manu, from your understanding of the exchange, do you think there are certain sectors which will be more attractive to this exchange than the other? What is the attractive quotient for you being from the e-commerce sector?
Look, the problem is, as I see it, today the new generation companies like the e-commerce segment where we belong to, where we are seeing very rapid growth, right? They don't become eligible to get a listing done, right? Because of the profitability criteria.
Right.
So a large segment of the new growth industries.
You're saying because your costs keep increasing as you keep growing?
No, because there is just so much of opportunity.
So
you want to invest more and more
into
the business and grow.
Right.
Well, even from an investor perspective, like listings like Make My Trip didn't happen in India.
It's not profitable 1 year.
It is not profitable, right? But they're still growing. So investors are missing on a lot of opportunity. Even if I look at my own company, we raised money from foreign investors last year. Even today when we are talking about raising money, because we see that today doing 5,000 transactions, we can actually do 50,000, and for which we need investment. But today also we are talking about raising $25 million, as against talking about raising 100 crores.
Sure.
Because there are no Indian players, right, we would get the investment from. So I hope exchange reconsiders that eligibility criteria.
I just want to bring in Nikhil from Stock Easy here, because it's a very similar company. It's a company in the internet space, online stock selection. Looking at your future earnings, when do you see yourself turning profitable?
We can be profitable, but the thing is, like if we earn profit and if we want to invest it in growing, then we cannot show that profit.
Sure. Feedback, Ashish, from
the
e-commerce sector.
It's an interesting question. It has been there perennially.
Right.
That and Indian exchanges have lost even large companies on those counts many times. And there have been, if you see, the regulations were changed for those kind of companies, even for large cap later on. So I don't see why this has to be kind of cast in stone, as you said.
Just to continue on the same line.
Sure.
So here we have retail investors as well as VCs as well as private equities. So can we have some kind of separation, as in a bunch of people are ready to invest into companies which are not profitable, which want to invest in growing?
Can we look at a subset within the same exchange?
No, as I said, once you have it's an interesting question that has been raised. There is a need clearly for doing it, and there are precedents in India for even large cap. The unprofitable large cap stocks, they have certain criteria. If they meet, they can still list, and we need to evolve it. It's just that the exchange has not even started. So to talk about what I call changes in regulations, I don't know whether it is advisable at this stage, but we have heard you loud and clear.
Yes, they've heard the entrepreneurs loud and clear. From eligibility criteria, we analyze the role of the merchant bankers on the exchange. That's coming up right after this break.
Actually, we have been widely interacting with merchant bankers, and we see the medium and the small merchant bankers, they are highly excited.